Okay, let's see how we go. All right. Well, some of you may know I had a bit of a blog battle last year with a certain well-known economist, Paul Krugman, which at various times got somewhat heated. And I think this Dilbert cartoon, which was unrelated, but I think is absolutely perfect what occurred. A bit of trash talking. Yeah. Dilbert starts off by Dogbert, I think, introduces Paul Krugman to the pointy-haired boss, and Krugman starts to launch into saying, for starters, if you knew anything about economics, you'd have a beard, etc., etc. And the dog explains the first few minutes are mostly trash talk. Well, that's certainly what I experienced when I went through it. And it began with him commenting on a paper that I wrote for the INET conference in Berlin. And Krugman said he tries to find the simplest representation. I very much enjoy the previous speaker's comments about how economists start with a point of ideology. I think it's not a simple story, but an ideological one they often start with. And he accuses me of not doing that and says that I contain a number of assertions about what's crucial without any real explanation as to why. And I like the last line, because if I give this in a seminar of economists, the normal reaction is, yes, so what? I hope I get a different reaction from physicists, because here he is saying that he's all for including banks in stories where they're essential, but why are banks so important to a story about debt and leverage? Exactly. So anyway, that's his starting point. And to me, this is the remarkable thing about economists. They model the economy as if banks, debt and money don't exist, which to me is a bit like modelling birds and trying to explain why birds fly by assuming they don't have wings. It's just crazy not to include them in the system, but that's what they do. So I want to go through why they ignore banks, debt and money in the macroeconomy. And intriguingly enough, even though Krugman wrote this critique of me, he'd done a paper with Eggertson where they tried to introduce debt, private debt, into an economic model, but not banks in the main part of the model and not money, strangely enough. So debt alone turns up. And they explain here that, yes, it's true that normally, even though private debt played a major role in people's explanation of where the crisis came from, it's abstracted from in conventional economic models. So their paper bringing private debt into the system and in an appendix also bringing in banks was actually an innovation in economic theory. Now, the rationale for not including banks is the simple argument that assets and liabilities balance. Well, assets equal to liabilities plus equity, but the basic idea is somebody's asset is somebody else's liability. Therefore, debt doesn't matter, ipso facto, starting straight from that one point. And this is quoting Bernanke now, and Bernanke got the position as chair of the Federal Reserve on the basis that he was the expert on the Great Depression. Now, the person who had a great deal of influence on people's perceptions of what happened to the Great Depression was Irving Fisher, with his debt deflation theory of Great Depressions that became a major part of Hyman Minsky's theory of financial instability. And here's Bernanke explaining that Fisher's idea didn't have a great deal of influence because of the counter-argument that a debt deflation represented no more than a redistribution from one group, debtors, to another group, creditors. Now, that to me contains the actually bizarre proposition that people who've gone bankrupt actually paid their debts back, which itself is weird. But for this reason, he ignored, as it was stated, Fisher's argument. He incorporated it in a asymmetric information type of way, but left out the argument about the actual level of debt being a major contributor to the crisis. And on we go with Krugman. This is from his book, End This Depression Now, where he says if you ignore the foreign component or look at the world as a whole, the overall level of debt makes no difference to aggregate net worth. He said it follows that the level of debt only matters if the distribution matters. So the aggregate level is unimportant. It's just the distribution of debt that matters from their point of view. And then he says elsewhere that when debt is rising, it's not the economy as a whole borrowing more money. I'm going to directly challenge that later, but this is the way they started reasoning. It's not more money being borrowed into existence. It's simply a case of less patient people borrowing from more patient people. Notice the pejorative terminology there, by the way. People who borrow are impatient. People who save are patient. Isn't that good to be patient? Not really. So their model of lending is literally, this is the terminology from the paper, patient agent lending to an impatient agent. And there was no distinction between banks and non-bank. Banks were just another type of intermediary. and you can pretty much ignore them in the modelling, and that's what they do until the very final appendix, online appendix of the paper, where they include banks to some extent. So the model is called Loanable Funds, and this treats the amount of saving that supplies money which can be borrowed as a function of the rate of interest. So the higher the rate of interest, the more people will save, while investment is a negative function. The higher the rate of interest, the less people will wish to invest, and the usual story of equilibrium between the two giving you the rate of interest. And banks are just intermediaries. You can ignore them in that process. Now, the alternative model, and I hesitate to call it a model, it's closer to saying a description of reality, is endogenous money. Banks make loans to non-banks, and they do it by crediting the deposit accounts of people who are borrowing money from the bank. And that creates a loan. The creation of a loan creates an expansion of the deposit at the same time. So creating a loan creates money, which expands the money supply and increases economic activity. Now, neoclassical authors reject this out of hand. And here's Krugman back on the initial sortie with me saying, I say once you include banks, lending increases the money supply. And here comes the trash talk. Okay, but why does that matter? He seems to assume that aggregate demand can't increase unless the money supply rises, but it's only true if the velocity of money is fixed. So have we suddenly become strict monetarists while I wasn't looking? And it says, in the model that he's got, because the velocity can vary in his model, but not the quantity of money, as I'll show, that has a variation. So what's the problem? Etc., etc. Definitely a trash talk experience. And then I say, and this is the part which comes down to the practical issue between the two perspectives. I assert that lending is an addition to aggregate demand. And Krugman says he doesn't get that at all. And he puts a very clear exposition of what is going on in the mind of a neoclassical economist when borrowing occurs. He said, if I decide to cut back on my spending, so I'm consuming less, and stash the funds in a bank, which lends them out to somebody else, who then spends them, that doesn't have to cause an increase in demand. It's a shift of demand from one person who's saving more to somebody who's spending more. Now, of all institutions, the Bank of England has recently come out on what I saw on my side. I'm not the only person there by a long shot, but the endogenous money side, saying that they quite strongly reject the conventional model. They say money is actually mainly bank deposits, and how these are created is misunderstood. A very mild way of saying what I'm saying about the conventional economists in general. The principal way is by commercial banks making loans, and when they make a loan, they create a matching deposit, thereby creating new money. So that's the Bank of England coming out definitively on the endogenous money side of this debate. Now, that didn't have much impact at all on the neoclassicals. Here's Krugman commenting on that particular paper saying, colour me puzzled. I've seen some people saying how great this paper is. It's some radical new way of looking at the economy, but he says it doesn't seem to be different to what he believes in the first place, which he derives from a very old paper from Tobin, which Tobin later largely retracted. He said the key insight that banks are more complicated, yes, sure, but they don't have unlimited capacity to create money, and they're not outside the usual rules of economics, meaning supply and demand. And he says, don't let monetary realism slide into what he calls monetary mysticism. Well, cut all that. In my opinion, the real mystics in economics are neoclassicals who try to treat the economy as a system of barter. We live in a complex commercial financial system, and we need to go from that barter mysticism to monetary realism. So what I want to do is contrast these two models using a software package I've developed with the help of INET and a Kickstarter campaign called Minsky. And that's actually won an award from SourceForge. It's an open source program. You can download it from the links I have there. That's a little leaflet to publicise it, with Minsky's classic statement of stability being destabilising. And it's a standard systems dynamics flowchart system. So if you load it and have a crack at it, you can put the Lorenz model together in a couple of minutes, as I show in an animation over here. I'll jump over that for the sake of time, but it doesn't take long to build something like Lorenz's model or Rosler, etc., etc. It's quite fit for that sort of purpose. But the main reason I had it developed was to enable financial modelling to occur. And the difficulty with using the flowchart paradigm for financial modelling, and you have to have every entry occurring at least twice in the model with opposing signs. And it's so easy to lose that when you're designing it using a flowchart approach. Whereas if you use double entry bookkeeping, which is the standard accountants invented, it's very straightforward to build a model. So that's what I've done. And I took the banking version of the Eggerton and Krugman paper and put that together in Minsky. And that's what goes on here. So the model that they have has a borrower agent who produces investment goods and a saver agent producing a consumption good. And the bank is an intermediary. The loan is between the consumer agent and the investing agent. And all the bank does is arrange it and charge an intermediation fee. And I model that in Minsky without making the usual neoclassical myth of lumping capitalists and workers into one agent, calling a representative agent. So I have capitalists have to hire workers, workers have to work in factories, etc., to produce output. And in the way that I show the double entry bookkeeping, each account is a column maintained by a particular social class. So there's the consumer sectors account, investment sectors account, workers, banker, and so on. And the transactions like paying wages and consuming are operations between the rows. And the program checks for consistency using double entry bookkeeping. So that's, I'll just quickly, pardon me, I should have pressed a click there. That should have, was not working. Let's try that again. That's not going very well at all. Okay. I think it's on the next slide. It generates a set of differential equations which are put in LaTeX, so you can see what the actual logic is behind your model once you've designed it. So this is showing the model with loanable funds, and the main operation that's occurring here is lending is between the consuming agent here and the investing agent here. So the loan is a transfer from one deposit account to another deposit account. And then once you've set this up, the loan is an asset of the consumer agent. So you can see the economy from the point of view of the consumer agent as well as the bank. So there's a table for the consuming agent and a table for the investing agent as well, derived by the program. And if you scan in and take a look at that, what you'll see is that the loan is an asset of the consuming agent. So there's the asset for the consuming agent. And it's a liability of the investing agent. So that's the matching that Minsky maintains for you, so you make sure your equations are properly linked together for a set of financial flows. Now, once that's done, you get 4 tables, one for the consumer, one for the investor, one for the worker, and one for the bank. And all the flows are defined using time constants, the engineering concept of a rate of time it'll take an element to double, or effectively the half-life of a decaying process, and so on. And these are variable by the program. You can change it while it runs. So I'm not saying this is the behavioural basis. I'm simply saying there'll be some numerical relationship between the amount of spending out of an account and the agent itself in that account. So putting it all together, that's the overall graphic vision. Each of those 4 bank-like columns is a financial view on the economy. These are the definitions down here. These are the variables where you can change those time constants. And these are the graphs of the amount of money, GDP, the velocity of money, which is the only thing that can vary in the neoclassical model, and rates of lending and rates of investing. So those are your social classes, and these are the variable flow parameters. So if I now run that model, let's hope I click properly here. Okay, I'm now running the loanable funds model, and with the rate of lending I've got and the rate of repayment, you can see the level of debt, the red line there, rising. And if I then change the lending so it happens more rapidly and change the repayment so it happens more slowly, the level of debt rises. You can see GDP is varying here, exactly in line with the variations in velocity. But there's no change in the amount of money in the economy. And if I keep on doing this for a long time, you'll see there's not a large amount of variation in GDP. The bottom here is 190, the top is 200. So that's fairly limited range. There's no growth going on over time. But let's add some monetary realism, which I can do extremely easily in Minsky, because the unreality here is the argument that a non-bank lends to another non-bank. What I'm going to say is the loan is from a bank to a non-bank, so the loan is not an asset of the consumer agent, it's an asset of the bank itself. And I can do that dynamically in Minsky. So I simply go inside the program here and alter that structure. So I bring up the table for the consumer agent and delete the column for loan as an asset. And then I knock off the 4 operations that are supposed to be financial flows. That's the consumer doesn't get the interest, doesn't get the repayment, and doesn't have to pay a fee to the bank. So knock all those off. And then bring up the column for the bank, and now insert a new column as an asset. And the program gives you a drop-down saying what assets haven't been allocated. That's now loans. You choose that, and now lending and repayment are automatically transferred into that column, and I simply have to move where the interest is across from being paid to the consumer agent to paid to the bank, and then delete this irrelevant column for a bank fee. So that's all the changes I've done. It takes about a minute to do it. And now rerun the program and see what happens. And what you see is the level of money and the level of debt are now rising, and GDP is also rising. There's now a trend because the growth in the money supply is causing a growth in the level of economic activity. If you vary the rate of lending and repayment, you can get booms and slumps in the economy, which you can't get out of the neoclassical model. You get tiny variations in velocity. And you can see the velocity is turning up down here as well. Velocity is varying. I'm not assuming fixed velocity. Again, that was trash talking by Krugman. No attention to what the actual paper actually said back in Berlin. This is the difference between the endogenous money view and the loanable funds. And clearly, the reason, which model should you use? The answer is whichever one says banks lend money. That's endogenous money. We should throw out loanable funds completely. And you can't understand capitalism without bringing them in. So let's look at the mathematics of this. The amount of money in the economy is the sum of the liabilities of the banking sector and its equity as well. So those 4 deposit accounts give you the amount of money in the economy, whereas debt is just the sum of loans. And I've only got one type of lending going on here. Of course, if I had more, there'd be different loans turning up there. But the dynamics of M is the sum of those 4 systems. So what's the actual total change in the money supply? We just go and see what cancels. And these are the various cancellations you get. Of course, everything cancels. You've got a conservative system. There's no change in the amount of money. And debt is a dissipative system. Lending and repayment one can be larger than the other. There's no necessary equivalence between the two. Now, when you look at that, therefore, what you've got is a system in which, first of all, money is conserved, and debt is a dissipative system, unrelated to the amount of money. So those are your 2 fundamental equations at the monetary level, money and debt in loanable funds. Now GDP, you can define the velocity of circulation as the ratio of GDP to the amount of money. And using that out and saying, well, GDP is roughly speaking velocity of money, which is derived in the system. I don't impose a definition of it. It's derived from the dynamics. GDP is velocity of money times the amount of money, and therefore change in GDP, because money is constant, simply reflects change in velocity. And that's what you can see in that simulation. When I take a look at endogenous money and check my cancellations, go through all those, 2 are left, lending and repayment. So the dynamics of money is the change in money is lending minus repayment, and that's identical to the dynamics of debt. So in endogenous money, what you have are 2 coupled dissipative systems. Change in money is the lending minus repayment. That's also change in debt. So you can substitute the change in debt for the change in money in any equation like the one relating GDP to the money stock. So you start from exactly the same position and say GDP is velocity times the money stock. But when you look at the change in GDP, then that's going to be your product rule. Money times the change in velocity plus velocity times the change in money. And that's the element that neoclassical economic theory is leaving out. Now, if you omit that, then it's no wonder you think debt has no effect. But of course, it's no wonder that debt has a dramatic impact on the economy. So if you ignore the change in debt, you're ignoring the major factor determining the direction in which GDP goes. So it's no wonder they didn't see the global financial crisis coming. Now, this is to give you an idea of the scale of change I'm talking about. This is America's GDP, the red line, and change in debt on an annual basis, change in private debt on the blue line. And the dotted line down the bottom is 0. So when the blue line dropped below 0, repayment exceeds lending, and you've got a contraction in the money supply coming out of that. You then look at what this means in terms of correlations between change in debt and economic activity. And what I find remarkable is I've been making this case now for 7 years, and I still have yet to see a mainstream paper analysing this empirical data. Because if you take a look at the correlation of unemployment to the change in debt, according to neoclassical theory, that should be effectively 0. Okay? It's about minus 0.88. I'm not a statistician, I haven't done the significance, but it's a damn tight difference from 0. And then if you take a look at the second order effects of this, and look at acceleration of debt and change in unemployment, and here I have to say Biggs, Meyer and Peck beat me to this. by doing empirical work on this first off. I didn't think the economic data would be good enough to support this proposition, because you're talking about a second order change and a first order change, but sure enough, they were right, it was. That's the correlation of the change in unemployment. I've inverted the changes to the acceleration of credit. The correlation there is again minus 0.89. And the same thing applies to share markets. Correlation between acceleration of margin debt and change in the S&P 500 is 0.64. And a similar thing applies even more strongly to the acceleration of mortgage debt and change in house prices, 0.83. So the data is screaming that the endogenous money case is correct. The analysis is simple to make the case that it's there. It's simply the a priori ideology of neoclassical economics that keeps us from properly including the role of banks, debt and money in our analysis of capitalism. So neoclassical theory, speaking to a group of econophysicists, you've got an open field because there is no dominant theory of capitalism. If you leave banks, debt and money out of your model, you're not modelling capitalism. You've got to be the ones who develop a replacement theory, one of the ones who do help do that. We need a new, strictly monetary, complex systems theory of capitalism, and it has to be non-equilibrium, obviously. I see the best foundation as being Minsky's work on the financial instability hypothesis combined with the work of Goodwin, giving us a cyclical growth model. And you'll see recent advances by Matthias Griselli and Bernard Costelima and a few others, now mathematicians getting in there and pushing the frontier rather further. So we clearly need a genuinely dynamic, non-equilibrium monetary theory of capitalism, and neoclassical economics is not that, and tinkering with their mainstream models, which all presume equilibrium dynamics, which I find an oxymoron, but that's what they do. It won't produce that theory. So it's over to you. And a bit of advertising at the end here. As you heard from Yu Cheng, I've just recently become head of school at the Kingston University Department or School of Economics, History and Politics, with the explicit mandate to make it into a strongly heterodox location. And I'd love to see plenty of your students turning up at my campus. Thank you.